market wrap up what happened this week from August 19th to August 22nd. We're about to see what were the major catalysts for these week movements in the market. So starting today, the market wrap up, well, the recovery status, the major US stock indexes have nearly recovered from the drop of the beginning of this month. The S&P 500 ended the week just shy 0.6% below its all-time high last month. The Dow finished 0.06% below its all-time high as well. And the Nasdaq, the one that it's lagging the most, still it's 4.13 below its record high. The S&P ended the week with 1.3% gain. The oil, 2% drop. The gold as well with a nice recovery and overall trend to the upside, 0.1% weak. And Bitcoin ended up the week also green with a 9.3% gain. The weekly gainers, most of these stocks were actually the ones mainly covered by media. Peloton ended up the week with a 50% gain. It's the biggest stock rise due to better than expected quarterly reports. Sales increased slightly, driven by subscription revenues, and announced significant cost savings and forecast improved margins for upcoming next year quarter fiscal year, despite lower sales and expectations from current year. Zoom Video seems like this a comeback from COVID stocks. Peloton Zoom, well, the stocks surged this week 20% and shares surged after exceeding revenue and earnings expectation, raised forecast and boosted by the new Zoom contract center platform. And RBC Bank maintains a positive outlook with a $95 price target despite upcoming CFO changes. Cava, big wins after also reported earnings with a 24.6% gain for this week. The stock reached new highs of $125 per share. Plans to open 54 to 57 new locations the upcoming year, previously upgraded from 50 to 54. Also, revenue rose to 35% to 231.4 million, surpassing analyst expectations both top and bottom line. And Stifel Bank predicts continued strong growth in same restaurant sales and new store performance. Cava also said that they are planning to have 1,000 locations for 2032. Target as well, after earnings reported, have a 10% weekly gain. Sales increased due to prices cuts on grocery and household goods, expanded children products range with better sales in clothing and beauty items. That seems to be one of the main guidance, beauty items, and raised earnings per share guidance for fiscal 2024 year, supported by new product launches and a new membership program. These were the mainly weekly losers this week for the S&P. Macy's with almost a 10% drop despite exceeding expectations for this second quarter. Sales were mixed and revenue gross margin outlooks have been downgraded for the upcoming year. Underperformance due to poor store performance, lack of investment and excess inventory, and high inflation, and these challenges raises concerns about group short-term recovery. Macy's, just as some other same stores as well as Nordstrom, have actually been struggling lately. Snowflake sales increased even though they got really good earnings. Seems like they weren't good enough for Wall Street expectations because sales increased almost 30% and free cash flow by 7%, but operating loss rose by 24% and net loss also increased 40% this second quarter. Struggles with declining revenue retention and margin pressures from investments in AI and graphic processing units, and doubts about the company's ability to compete against AI technology, with forecasts for the next quarter below expectations. That was the main hitting. Both revenue and net income forecasts were actually below Wall Street expectations. JD.com ended up the week almost 9% down. Disclosed that they withdrew from JD Investments, selling at a stake of 11% discount, leading to a sharp drop in JD's share price. JD did not report earnings this week, but mainly was due to the fact that Walmart will exit its investment on JD. Also raised concerns about JD's ability to compete with more profitable rivals such as Alibaba and PDD, especially with significantly lower operating margins. And some major news as well, as we saw oil prices have been falling, and also falling yields as interest rate cuts are imminent impact. The growing expectation from interest rate cuts led to volatile week for the US government bonds. The 10-year US Treasury yield dropped to 3.76% on Wednesday, just above its year-to-date low. And also the yield history, well, the yield reached highs almost 4.7% in late April, when rate cuts seemed less likely. Now the market expects 3 rate cuts for this year. Oil prices declined as well. US crude oil prices briefly hit a 6-month low on Wednesday, falling to $71.46 per barrel. Despite a rebound on Thursday and Friday of this week, oil prices fell overall 2%, trading below 75% on Friday and down around from $27 the previous week. As well, some of the major reports for this week, I will focus on these two main ones: job growth and lower mortgage rates. Job growth revisions: the US revised growth estimates with a significant downward adjustment, showing that the labor market wasn't as strong as initially thought. On Wednesday, it was reported that the employers added 818,000 fewer jobs than previously estimated for the past 12-month period ending in March of this year, based on Statute of Employment Office records compared to earlier employer survey estimates. So it seems that the labor market is actually weaker than we once imagined. Also, home sales increased. Sales of privately owned homes rose by 1.3% from the prior month, as reported by the National Association of Realtors. Home prices slipped also for the past month from June, but remained close to the record high, with a median sales price of $422,600. And one thing I want to focus is a rising unemployment. As we already saw, the SAM rule was already triggered after a 0.5% unemployment increase over the past 4 months triggered this rule. But the rising employment, the number of states with increasing joblessness is at its highest level since 2009, with the 12-month average doubling recently. This trend could push the national jobless rate to 5.5%. Already, Jerome Powell already stated that he doesn't want to see any more coolness in the labor market, but that's about to see. So there's going to be a lot of focus in the non-farm payrolls reports for every month. And as we see, there's a trend incoming here for the rising unemployment rate, which can be a little bit worried. And also with the housing market, which is distorted a little bit. Right now, the median price per square foot for new and existing US homes, it's actually existing new homes are more expensive than new, which might be a little bit worried because it's a market imbalance. New homes are actually $3.5 cheaper per square foot than existing ones, the largest gap since 2005. And the price increase: existing home prices have jumped 70% in 6 years, outpacing the 50% rise in new home prices over the past 6 years as well. There has also been some major events according to also lumber prices, which have actually dropped to its lowest level in the past 4 years and dropped 80% over the past 2 years. As the Fed pivot approaches, the Federal Reserve Chair Jerome Powell already announced that it's time for a policy adjustment, hinting an upcoming interest rate cut for the upcoming meeting in September 18. Economic indicators: he highlighted that the labor market has cooled and inflation is moving closer to the Fed's 2% target, but he doesn't want to see any more cooling in the labor market. The countdown to rate cuts: well, as we see here on the left side of the chart, core CPI has actually dropped from highs of 9% to 2.9%. So there's some progress done. It's already reaching the Fed's target, which has been the main focus overall for the past 2 years. And the job growth unemployment rate. Here, this chart on the right sees that as rates have been held steadily, actually unemployment has risen from decade lows of 3.2% to 4.2%, which has actually this weaker jobs report created some recession fears for the month of June, but recent data actually eased these concerns. And well, we're about to see not an average rate cutting cycle. The Fed policy rate prior rate cutting phases. Unlike past cycles, the Fed isn't cutting rates to counter an economic downturn or financial crisis, but to ease off the break after 2 years of tight policy. And gradual adjustments: with inflation falling and unemployment rising slightly, the Fed aims to reduce rates gradually to move closer to a neutral monetary policy. Rate cuts can extend market rally. This is very interesting, as we see here, because as the stocks have actually rallied and treasuries yields have fallen from anticipating Fed policy rate cuts, we see here that the 2-year rates are down 130 basis points and stocks have been up 37% since October of last year, when the broader market rally actually started. And on the right side, we see the market performance after initial rate cuts, that it's often positive. On average, since 1980, the market tends to actually go up around 12%. The year prior, the first rate cut is actually in place. And some of the memes of the week that I actually like: how millionaires were in 1980 and how millionaires are in 2024. Seems like drinking Monster doesn't actually give you millionaire status. I hope it actually does. And one of my also favorites: when you buy and when you sell. Seems like happened to me, at least whenever I buy, it seems like it's the resistance of the market, and when I sell, it's the bottom. So I hope everybody liked this video. I hope you found it useful. We will see you on the Bad Trader live streams every day from Monday to Friday. You can download the app on both Google and App Store, and thank you very much.